How is it possible that my local bank can only offer 0.1% on my savings, but in DeFi 20, 30, even 100% APRs are available? Are DeFi protocols and products built on top of them just a giant Ponzi scheme, or is there real value being created and distributed? In this video, I'm going to show you exactly where yield comes from and why governance tokens play such a big part in the DeFi economy. We'll end with a note of caution about the sustainability of the current yield farming model. Good morning. My name is James Buccini, and I create content about digital assets, decentralized finance, and blockchain development. I'm not a financial advisor, this is not financial advice. Many DeFi protocols have revenues coming in, and this can be from a number of places. It might be a demand for borrowing, and people are willing to pay for that privilege, or it might be from trading fees, for example, like on decentralized exchanges. There's a number of reasons why people might pay a percentage fee to borrow funds. One of them would be a yield farming strategy. In DeFi, a lot of the borrowing that happens is based on over-collateralized loans. What that means is someone can deposit 100 ETH and they can borrow up to 80% of that in stablecoins, for example. They can then keep any gains on that Ethereum because that's locked in the protocol, and then they can use the stablecoins for a yield farming strategy. Another reason might be to short an asset. They can essentially deposit stablecoins on a lending platform as collateral, and they can borrow a more volatile asset, betting that the price of that asset goes down. They can sell the asset on exchange, which they've borrowed, and then buy it back later to pay back the loan. The other reason that people borrow funds is for tax planning. This is all a little bit of a grey area in most jurisdictions right now, but in some places it's been suggested that borrowing funds on a DeFi protocol might help alleviate some of the capital gains tax. You essentially don't pay capital gains on borrowed funds. So having that borrowing platform, you can deposit a certain amount of your digital assets, borrow US dollar stablecoins on top of that, and then extract that from the system to use for real life expenses. Next, we have trading fees. And if you think about a decentralized exchange, they're charging, say, 0.3% is a kind of standard fee on Uniswap for a user to trade one token for another, or a base asset for a token. These fees are generally paid to liquidity providers, and then DeFi protocols and yield farming strategies and vaults all make money from providing that liquidity to the exchange. The other thing that isn't completely widespread in DeFi yet, but we're starting to see more and more of it, is fees for leverage. On centralized exchanges, we've seen perpetual futures really take off, and that's the dominant part of the market now. And how this works is that traders can either go long or short on these perpetual futures contracts. And if there's more people that want to go long than short, then the longs pay the shorter funding rate premium. This opens up the cash and carry trade, where a trader can buy an asset on spot markets and sell it on a futures to collect that funding rate premium. They're hedged to US dollar. There's also options products, which are starting to become more popular in DeFi. And again, this is another derivative product. It opens up different strategies, something like what Ribbon Finance are doing, and covered calls and strategies like that on top of decentralized options protocols. It's another way to bring revenues into the system. So many DeFi protocols are redirecting those direct revenues through to liquidity providers as yield. But that's not where the vast majority of the yield comes from. When you see these really high APRs on DeFi protocols, that's normally through the distribution of a governance token. DeFi protocols need to incentivize investors to place their funds in their protocol. To do that, they distribute ownership of the protocol itself. Governance tokens hold value because they provide voting rights on the future of the protocol, the distribution of new tokens, and the allocation of sometimes vast amounts of treasury funds. Uniswap, for example, has a $7 billion treasury fund. If too many governance tokens are distributed too quickly, then the price of that digital asset will drop on exchange. We've seen this a lot with farm tokens. Whereas in a perfect scenario, you want to see the growth of the protocol outpacing the supply of new tokens, which causes price appreciation, which further incentivizes liquidity and further growth. So is decentralized finance just a giant Ponzi scheme, or is real value being created here? The first thing I'd say is that we've never really seen a very negative bear market. DeFi's only been around 2 years, and it's never really had a thorough stress test. If that inevitably does happen at some point, then we might see a rush to quality, where the protocols that are generating real revenues and have real users outperform the latest and greatest farm tokens. That's not to say that you want to hold highly volatile DeFi governance tokens for a bear market, because they're still likely to lose value relative to the US dollar. So to answer the question directly, is DeFi a Ponzi scheme? No. It's clear that these DeFi protocols are generating real value through the revenues from trading fees and borrowing fees, and there's a whole industry being built here. The governance of this future industry holds a lot of value. For the foreseeable future, the yields are going to be high because of the value asserted to those governance tokens. I hope this has clarified where yield comes from in the DeFi ecosystem. If you're interested in learning more about digital assets, decentralized finance, and blockchain development, subscribe to the channel, hit the like button for the YouTube algorithm, and thank you for making it to the end.